Hey there, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, February 5th, and you are tuned into On Trend, the show designed to keep you on the right side of the trend. So we got a big show for you. We're going to review the turn of the month strategy because the turn of the month ends on Wednesday. I'm going to show you how to use RSI to define the broader or the bigger trend. Then we'll look at some leading industry group ETFs within technology, show you 4 techs that are teetering at their make or break levels, and we got 6 healthcare names, plus a few stocks to watch. We're going to start with the turn of the month because the 8-day turn of the month period ends on Wednesday. I wrote an article on the 25th of January featuring the turn of the month strategy, and that can be found on Arch Charts. There's an articles link at the top of every web page, and you see the All Blogs link on the right. And if you scroll down, you will see a link for Arch Charts. And yes, it is behind the paywall. It is for members only. So this is the article, A Race to the 200-Day Moving Average. And if you scroll down, you can see where I talk about the bullish turn of the month strategy. And basically, the bullish turn of the month covers a period consisting of the last 4 days of one month, say January, and the first 4 days of the next month, say February. So here are the last 3. You had October, November, this 8-day period, and the S&P 500 was up 1.8%. Then you can see in November, December, the S&P 500 was down 1.5% during that period. And then from late December, of course, to early January, we had that huge 8.5% gain. Now, of course, 3 instances don't make for a strategy, but, I ran the numbers over a 20-year period, and 64% of the time the market was up during this 8-day period, and the average gain was 2%. The average loss was the same, but it was only down 36% of the time. So there's clearly a bullish bias during this turn of the month. And that's why I thought that this uptrend could extend into early February. There's a little table also down here showing you the numbers. So if you had just bought this strategy using these 8 trading days, 12 times a year, you would have gotten 6.49% annual return, and you would have been exposed to the stock market just 38% of the time. So you could have done something else with that money 62% of the time. And that's what makes the risk-adjusted return high. So, it's not a strategy I'd recommend trading blindly, but it gives you an idea that, when you come to the turn of the month, you can get a bounce more times than not. And so now that we're ending this turn of the month period, which will be on Wednesday, then we could see a pullback in the market. So you can see that when this article was penned in the latter part of January, we've had a little run up to that 200-day in the S&P 500. And so we're kind of in this no man's land, I would call it. You can see that we are below the highs from December, which mark resistance. We're right at the 200-day. We're below the 200-day for mid caps and small caps, and we're right at the 200-day for the NASDAQ 100. But this blue zone represents the prior trading range, and we're coming into this zone. We're quite extended. I still am long-term considering this a downtrend and a counter-trend rally. I could be proven wrong, but at the very least, we're extended. We're coming into that end of the turn of the month period, and that could give way to a pullback in February. So yesterday in Arch Charts, I noted that we had a doji on Friday, and we also had a doji the previous Friday. And these are small candlesticks, a signal indecision. We got a gap down after the previous Friday's doji, but you can see after this one, we moved higher on Monday. And we've been moving higher since this pennant breakout. So I think the first level to watch is that kind of breakout zone there at 265. So if we cross below 265, that's throwing cold water on the breakout. And as far as support is concerned, 260 is the last low there from the latter part of January, and RSI needs to go below 50 to reverse the momentum uptrend. When we look at QQQ, we can see similar action here with a pennant breakout and a gap last week. So that would make 165 the first level. If you go below that level, then you're getting some cold feet here on the bounce. But as far as support from the prior lows, you need to move below 160, and RSI needs to go below 50 to reverse this short-term uptrend. Now I want to show a little technique to measure the consistency of an uptrend, because I think an uptrend consists of two parts. And for an uptrend to be consistent, you need both of these pieces to be in place. And the first one would be higher highs and momentum pushes to the upside. And the second piece of that puzzle would be higher lows and limited downside. And if you can get both of those together, you've got a consistent uptrend. And to do that, you can use RSI. In particular, you can use RSI ranges. And let's look at two examples. So the first two examples are going to show a shift from a bullish range in RSI to a bearish range in RSI. Now keep in mind that each stock is different. Some might have a smaller bullish range and some may have a wider bullish range. If you look at Amazon here, a little bit of a volatile stock sometimes, but you can see the green area there is highlighting a bullish range. You had the move above 70, and then every dip got to the low 30s, but didn't go below 30, so you didn't become oversold once. And during this period, you had several pushes above 70, and so that showed you that momentum was remaining strong throughout. And look how strong Amazon was at the end of 2018 there, when RSI barely moved below 50. And then we had a change, all right? This is where RSI moved well below 30, and you can see the stock started breaking down, then it broke its 200-day a few weeks later. And since then, it's been below 30 a few times, and RSI has not been above 61, I believe. So Amazon is losing momentum, or it has lost momentum, and RSI is in its bear range. And before I would put it back on my radar, I would like to see RSI push above 70, and then I would look for pullbacks. But as far as the trend is concerned, I think RSI is in its bear range. It has shifted. We look at NVIDIA, we can see a similar example here of a trend shifting with RSI, calling it. RSI moved above 70 way back here in March 2016. And you had some dips to the low 30s, but you didn't go below 30. And there were several pushes above 70 over that 2.5 year period. And even as late as August, you had RSI moving above 70. But things changed when RSI moved below 30 in October. And you had several moves below 30 over the next few months. Now, RSI is improving here, but it's still well below 70, and you've yet to get that push that says, hey, there's enough momentum to become overbought. And when that happens, then I would put NVIDIA back on my radar for a potential bullish setup. Now, this next one shows ADC Realty Corp, and it is switching from a bearish range or a volatile range to a bullish range. Because you can see during this period, RSI was above 70 several times and below 30. And the price was accordingly not moving. But then the range shifted to the upside because you kept getting above 70 in RSI, but you can see that the dips did not go below 30. You had one dip to the low 30s, but most of these dips found or reversed around 40. And so that was the bullish range for RSI. And you can see that the uptrend here is clear in this stock. And finally, we have Sienna moving from a bullish to a bearish range. And these aren't perfect signals. There's no such thing as a perfect signal in the stock market. All right. But you can see here that we got that push above 70. We got another push above 70. And in between, we held around 40. And during October, when the market fell apart, we didn't go below 30. Any stock that didn't have RSI going below 30 in October was holding up very well. And look at this November, December period. RSI did not go below 40 there. So that was holding up during the pullback here, and you had higher lows in the stock, so it was holding up. So RSI is in the bull range for Sienna. Sure, it's got a gap down last week, but the bigger trend is up, and if it comes into that 34, 35 area, it might be an opportunity. HACK and SKY continue to lead the tech ETFs higher. So HACK has just been off to the races over the last 5 trading days. You can see this big move here. But believe it or not, there was a tell. There was something that was foreshadowing this strength. This is a 30-minute bar chart. It goes back about a month and 5 days. I've got SPY in the top window. I've got HACK in the little window. And you can see that SPY started trading flat, and it got that surge on the 25th. And HACK was also flat, but HACK moved above its prior high, whereas SPY did not. And that right there told you HACK was leading because it got above that prior high. The same thing happened a few days later. HACK was moving flat, so was SPY after a gap. And then you had HACK moving above that high on the 30th, and SPY was not. And so that's what I call relative chart strength. These are benchmark highs, all right, that both of them have. And SPY did not make it above this first benchmark high, whereas HACK did. And SPY did not make it above the second one until a few hours, a day later, and HACK was already above it. And so that early sign of relative strength was a bullish indication for HACK. That's something to keep in mind going forward. So looking at technology, I've got 3 technology ETFs here. We've got the equal weight technology ETF, RYT, in the top window. We've got the small cap technology ETF in the middle window. And we've got the technology SPDR XLK in the lower window. And XLK is the laggard of the 3, believe it or not. And I'm basing this on the benchmark highs. My benchmark highs would be these November, December highs, which is marked by the blue line there on each chart. And you can see that RYT is just above those highs, clearly leading, and so is the small cap technology ETF, leading, whereas XLK is not. It is lagging those two because it is not above those highs, but it's still in the midst of a pretty strong short-term uptrend. Now you can break down the technology sector into industry group ETFs. And I've got 5 here that I want to show you that are all within the technology sector. So it's a great way to break down the sector and pick the stronger parts of that sector. And you could even take this one step further. You could go to the First Trust website for the First Trust ETFs, and you could find the components in SKY, and you could look at those individual charts to find the strongest stocks in this ETF. That's another good way to use ETFs because it is very easy to find the components and then single out which stocks are leading. Now, if you look at this chart here, again, I've got the benchmark high here. There's the November high. There's the December high. And you can see SKY has moved above both and above its 200-day, whereas XLK has not. So clearly SKY is one of the leaders. And remember this level for RSI, it is at 68.74. And you can kind of use the RSI level to compare relative momentum, if you will, among these ETFs. So we got 68.74 for SKY. And the next one, you can see that RSI is above 70. And I just showed you the RSI strategy before there. So RSI is like 75 here for HACK. It's got the highest RSI of these 5 ETFs. So it is clearly the leader as far as momentum is concerned. And you can see during this December decline, RSI did not become oversold. It touched 30, but it didn't go below 30. So HACK is clearly leading. And you say, well, my gosh, HACK is 31 to 39. That's like almost 30%. I'm not going to chase it. Okay, fair enough. I would wait for a pullback here if you didn't catch an earlier breakout here when it was, giving us the tell right around here in late January or the late part of January. But, a pullback maybe to that 36.5 area might be reasonable for a potential opportunity, but it's one we want on our radar going forward. We look at the First Trust Internet ETF, and we can see that it too is moving above the 200-day and above those November, December highs. RSI is not above 70 yet. It's got a little more work to do. And you can see that RSI was below 30 twice in the last few months. So we're not yet in a bullish range there. We look at the semiconductor ETF SOX, and it is not in a bullish range for RSI. You can see we've moved above those November, December highs and above the 200-day, but it's clearly not as strong as HACK or SKYY, the first two I just showed. And you can see RSI is at 63, so it's one of the weaker RSIs. And you can see it was already weakening because RSI was oversold in October twice, almost oversold in December, and it's not been overbought since June. That's how weak the bounces have been in the SOX over the last 6 months or so. And software is leading. You see RSI is at 69, so it's almost at 70. I put this one in third place as far as the technology ETFs. But clearly, a big move above these highs here. So is it getting overextended? Sure. But, put it on the radar for a pullback, I would think. So despite some strength in technology, there are some stocks that are teetering. In other words, they're on the verge of either breaking out to the up. So this first chart is a shorter term chart of Amazon to give us some more granularity. But it is at a make or break level. You can see the highs from November and December, and we haven't gotten above them yet. So there's a clear resistance zone there around 1750. And if you look at this, we have basically a 3-day reversal. We have a surge, a close strong above the 200-day, and then a plunge. But we haven't gotten any downside follow through to this. And there's a clear support level there around 1600 because, we bounced off this level 1, 2, 3, and we're at it the 4th time. So if we break down here, that's going to be negative for Amazon because it's already in a bigger downtrend, I think, and that could set up a test of the December low. Amazon, of course, is the biggest component in the consumer discretionary sector, SPDR XLY. So Google reported earnings, and it moved down around 2% after hours. And you can see that it was basically up 2% yesterday. So it's going to give up those gains and move right back down into that 1120 area. But you can see it's a clear battle zone. There's that November high. And it looked like we were moving above the 200-day and above that high. But we're going to fall back today. So this is a resistance zone to watch going forward for Google. And we need to get a breakout here. So if we can get the breakout in Amazon, get the breakout in Google, then those are going to be very positive developments for the broader market. But these are big gorillas, as far as the market is concerned. And if Google, there's a clear support zone there from these lows. And if Google breaks those lows there, then that is going to be a bearish development. And Google's lagging, pretty much because it can't get above this or stay above this early December high. Intel is another one that is dragging its feet. And if I look at this overall chart, I basically see a consolidation within a downtrend. When I look at a chart, I am first interested in the bigger trend. And the second thing I look for is the current pattern a continuation pattern? Because if the bigger trend is down, which I think it is after this big decline that we got here, and then we have this kind of triangle consolidation here. And a triangle consolidation after a decline is typically a bearish continuation pattern. Now you're seeing some interesting price action because Intel has filled the gap. So it's not going quietly. And, you got a clear resistance zone here around 50. So if it can break out there above that late November high there, then that's going to be a bullish development for Intel and the semiconductor group. So that's something to watch because, this is an impressive move to fill the gap. And then Microsoft. All right, Microsoft, it's all about the cloud. So Amazon #1 in cloud, Microsoft #2, and Google #3. And I believe that all three are growing their cloud business quite fast. So if you look at Microsoft, you say, what's the bigger trend here? Well, I would say the bigger trend is up. All right, you have this huge advance to 52-week highs, and you have a decline. And, looking at this decline, okay, it is pretty choppy stuff, but I'm going to have to there we go. It's pretty choppy stuff. So you're down, then you're back up, and then you're down. But now we're right at this 200-day. And there's clearly a lot of support in that 102, call it 100, 102 area. And Microsoft got this little bounce, and now it's pulling back. If it can get above 108, I think that's going to be a nice little breakout area that could lead to a challenge to those highs around 116 for Microsoft. So the healthcare sector is pretty bifurcated, but I am seeing some leaders, and I got 6 stocks to show you here. So this chart here shows the high-low percent indicators for the S&P 500 and 9 of the 11 sector SPDRs. I don't have REITs, which are leading in new highs, and I don't have communication services yet, but I'll get those on. But what I want to point out is that healthcare is showing some leadership with a number of new highs. If you look at this chart here, you can see that high-low percent for the S&P 500 has not touched that 10% level. You need to get above that level to get some critical mass and new highs to support a bull market. Utilities are the only sector that have a bullish indicator here. It moved above plus 10% in June and has been moving above plus 10% on a regular basis. Technology is in bear mode, but then you look at healthcare, and last week you got 2 readings right around plus 10% for high-low percent. So that tells you that there are healthcare stocks out there that are making new highs, and there is strength within this sector. This next chart here shows the percentage of stocks above the 200-day EMA for the S&P 500 and the 9 sectors that I've selected here. So you can see for the benchmark, the S&P 500 is at 58.2%. It's on the verge of crossing above that 60% threshold. Utilities are leading at 96%. Technology is actually showing some leadership at 69%. And then in third place, we have healthcare at 63%. So that tells you that healthcare is one of the leading sectors in a otherwise fragile market here. So it's one of the sectors I would look in for individual stock setups. Now, I don't need much on a price chart to give me all the information I need. And on these charts, I've got the 255-day price channel, which is the pink line there. That marks the 255-day high, which is a 52-week high. So you can see Abbott here hit 52-week highs throughout June, July, August, September, and then even in early December. And then you can see when we had the decline there into late December here, Abbott basically held this low here. So it held support, it held the 200-day, it held up well during the decline, and it is right back near a 200-day. So overall, I would view this as a consolidation within a bigger uptrend here, and I would expect a resumption higher. Might not be the most exciting stock, but sometimes that's what it takes. Next up is Danaher, and this is medical, or I think it's medical equipment basically, kind of a conglomerate if you look them up. But man, this stock's been all over the place. It had a pretty nice choppy uptrend here, and then it just took chop to a whole new level here with these moves from 110 to 95, basically 15% swings, 1, 2, 3, 4. So yeah, these swings are pretty tough to stomach, but the trend here is clearly up because you're near a 52-week high. Not many stocks hitting 52-week highs now, but Danaher is, and it's a leader. We had Edwards Life Sciences, and Edwards is breaking out. Greg Schnell highlighted Edwards, I believe, in a Don't Ignore This Chart article. And you can see here this triangle, big triangle within an uptrend and breaking out of that triangle there. So it looks like Edwards is on its way to a new high. Now, Lilly reports in a couple days, so be careful here. But look at that leadership there. You know, it was hitting 52-week highs in October, in early December, and now here in early February. So a clear uptrend and clear leadership. Leadership attracts attention from the institutions. And that's where you want to be. We look at Merck. Now, Merck has a relatively fresh breakout. The stock did hit a 52-week high there in early December and then kind of consolidated. And you can see the gap and the breakout. And I think that was a reaction to earnings. But it looks like it is heading for a new high. And then Pfizer. Now, this is where the cynical part of my analysis comes out because, you know, support and resistance levels, I'm not so sure about them anymore with, you know, the extra volatility and the high frequency trading. I think what you have to look at is the structure of the chart. Is the long-term trend up on this chart? Well, you know, clearly it was when you're hitting 52-week highs. And then you got this big decline, and oh my God, you broke support. And oh my God, then you broke the 200-day. But if you look at the pattern, it was a wedge, or it is a wedge. So a wedge is typical for a pullback. I'm sure you get a retracement on there that would show around a 50% retracement, and we're breaking out of that wedge. So Pfizer is showing some breakout potential here and ready to challenge that high. And we'll finish with a few stocks to watch. So first up is Ultra Beauty, and it has had some beautiful volatility with that big decline and that big move right back above the 200-day. Right now, the pattern at work here is what I would call something like a high and tight flag. You basically had this big move up, and now you've got a tight consolidation, and I'd be watching for a breakout to the upside there and a continuation higher. Next up, we have Wingstop, and Wingstop is a leader because it is hitting 52-week highs. That's all you need to see. You see a 52-week high and within the last month or two, it's a leader. And then you look at the pattern at work, looks a bit like a wedge, and we're breaking above that wedge line. So it looks like that uptrend is continuing. Now, Maxim Integrated Products is not in an uptrend, but you can see a double bottom of sorts. And then you have that resistance level there. But just below it, we've got some sort of volatile consolidation, maybe a pennant. So watch for a little breakout at 56 to get this one going for a double bottom breakout. And then we have Teradyne, which has a high and tight flag forming. It's part of the semiconductor group. But, you know, look at that big move up with the gap. And, you know, if you draw your lines, you got to pin it or something like that, a consolidation after a big move up, and a breakout there argues for a continuation higher. And finally, Finis Air is showing some life here. Got the big gap up, and I think the bigger trend is up clearly with this higher high. There's the 52-week high right there. So we had a pullback, a little bit of a stall, and now we've got a breakout there. So it looks like Finis Air wants to move higher. So that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.
Is your portfolio positioned to profit from continued market volatility in 2019? Join over 100 investing and trading experts, including policy guru Steve Forbes, emerging markets icon Mark Mobius, America's best income investor Bruce Johnstone, elite energy analysis Stephen Schork, and trading visionary Tom Sosnoff at The Money Show Orlando to get the best ideas for protecting and growing your investment portfolio during 250 in-depth presentations. Claim your free pass now at orlandomoneyshow.com.